welcome to another accounting video. This time we're looking at credit purchases, so we've done cash purchases previously. Have a look at that video. Alternatively, you could just like and subscribe, like this video, subscribe to the page, and then, you see everything and makes you a better person, I think. Who knows? Anyway, we are doing credit purchases. Now, this is a big change from what we've done previously, where we've dealt a lot with cash. So today we're looking at credit purchases. So the first thing we need to know is it concerns only inventory and the accounts payable. And there's going to be a very set method for what we do, and it'll make sense. So we're going to be looking at the purchase on credit of inventory, purchase returns, and repayments. Now, I was going to add discount expense in there, but I decided on holding that till we do discount revenue as well and treating that just as a whole discount thing. So that's when that'll appear. But that is also there. That'll build upon the knowledge. So you kind of got to watch this video, then that video. So, yay. So let's just jump straight into this. And let's do our set of 3 transactions. So we're going to be working with a through line of 3 transactions the whole time. So if you're ever stuck, do go back to these transactions. So the first transaction 1, purchased $5,000 worth of inventory plus GST on credit. The terms are 5/7 and N/30, and this is invoice 10. And I'm going to talk you through. So 5/30. 5/7, and N/30. What that means is our credit term. So 5% discount if paid within 7 days is 5/7. So if we're paid back or we pay it back, we get a 5% discount. Otherwise, we need to pay within 30 days or it's overdue. So it's like on your electricity bill, when you pay early, you get given a discount. It's like that. Invoice 10, this is one of the few times I'm going to talk about or in detail the source document. So source documents, anything on credit will always be an invoice. So please remember that. And it's up to you to work out, are we purchasing or are we selling? But either or, it is still an invoice. So that bit of close reading required there. The reason I've talked about on the cash ones is because when we sell something, it's a receipt. When we buy something, it's a check. And that's always going to stay as is, and that's very consistent. Anyway, on the 10th, unhappy with some of the product, $440, including GST, was returned. This is credit note 11. So the source document here, anytime there's a return on credit, it is a credit note. And on the 15th, we paid $2,000 to a supplier, and the name is supplier. So check 12. That's just a basic cash. So what we're going to do is we're going to go through the general journal. Then we're going to put it into the ledgers. I'm going to show you how that all looks. And then after that, we're going to look at the reports. And in this case, it's only the balance sheet. So let's have a look at our general journal. So we can see on the 1st of June, inventory, because we receive inventory, asset going up is 5,000. We have paid GST, even though we haven't physically given the money yet. GST is still calculated when it occurs, and that GST clearing is a debit of 500 because we now owe less. That obligation is lower. And then accounts payable, 5,500. That's how much we owe in total to the supplier. And then obviously you've got your narration. We're going to be building upon this transaction. If we have a look at the 10th, we can see that it's a reverse of the purchase of inventory. So in this case, accounts payable is a debit because we owe less. GST is a credit because we owe more, because we're being refunded. So they're giving us back GST, so we're sorry to make it up. And then inventory is going down because it's going out the business back to the supplier. And again, that's a credit note. The math here for the GST is 440 divided by 1.1 gives us 400. 400 times 10% is $40, and that all adds up there. So just a quick reminder there for the GST, that is the transaction on the 10th. Building upon that, we add the 15th, where they have paid back $2,000, and in this time the accounts payable goes down. If it's a liability and it goes down, it's a debit of $2,000, and bank is also $2,000, and that's an asset. Bank asset going down is a credit of $2,000, and then you've got paid $2,000 to supplier, check 12. That is how everything fits in, and that all plugs into, if you have a nice look here on the general ledger, we see every transaction come together. So you can see the first is the debit. So this is the accounts payable general ledger. And one thing I really want to note here is inventory / GST clearing. If it's one transaction, you need to go item 1 / item 2. Now, what about the balance? Now, you see on the 10th, it's the purchase return, and it's the same transaction except reversed, and we talked about that on the 10th. And then you've got the bank, which makes it go down again, and that again is a debit. And then we've got the balance, and we've balanced that off here, and you can see the final balance, $30.60 or $3,060. Now, there's only one account that this $3,060 goes in, and that is the balance sheet. Now, I want to talk about the bank briefly. The bank, obviously going down, will be a cash outflow. So if you look at your cash flow statement, you'll see it is in the operating activities, and it's under the classification payments to accounts payable, and that'll go in there. It's not an expense in any capacity, so there is no income statement, but that's where it will appear in the cash flow statement. Now, how does this appear on the balance sheet? Quite simply, it is current liabilities. Accounts payable is always current liabilities. And the reason this is given away to us is because, quite simply, the terms N/30. It is due within 30 days, and we know 30 days is within 1 year. So that is where that fits in. Now, I was going to talk about accounts payable turnover, but I'm also going to tack that on to the end of the discount revenue, discount expense, because I sort of want to summarize that as a essentially 3-part series. So on that note, thank you for watching. Hopefully this helps you. Remember, like and subscribe, and I will see you for part 2, which will be credit sales.